Hi, it's Lee and welcome to the Tesla Economist. A lot of my videos do evolve from various comments I get. I have a lot of great listeners who do give good feedback. In fact, people often ask me, how do I make so many videos on Tesla? Well, a lot of it is just information I would like to know as a Tesla investor that may be useful and offer some perspective. But a lot also stems from you, my viewers, or at least those of you who comment. I read just about every comment and it gives me a feel on what the overall narrative is out there, or emotions on Tesla, the company, and the stock price. Right now, I feel that there are two reasonably big issues on most people's minds, and they're perhaps even the same issue. I do estimates based on what Elon tells us or what he thinks Tesla can achieve when it comes to production, and we almost always assume that production is the number that matters. Tesla has unlimited demand. If they can build them, they will come, which was very much true up to recent, except now the economy has changed. One of the big ones that everyone mentions is China. Demand for Teslas is drying up in China. And then the other is the overall demand for Teslas will also reduce. Therefore, I thought we could discuss these matters and see what it actually means and what are the real consequences here. China has definitely been carrying Tesla this last few years, no doubt about that. China's the largest car market and going big on EVs. However, what China has done the most for Tesla is the production side. Supply more so than demand. Yes, there has been some good domestic demand for Tesla in China, but it made sense to cater to the local demand first. It's cheaper to ship to the same country the product is made. There are no tariffs either. But I think too many people are caught up on China supply and demand being the same. China is where Tesla could make very low-cost EVs with the technology they had at the time. I doubt there was a cheaper way to build a Tesla. Chinese Teslas are the current lowest cost versions, and China has been set up as an export hub anyway. But like I said, no point exporting if local demand is enough. Now, Tesla have ramped up considerably. These cars do need to be exported more. And although these are very low priced Teslas, China is not a wealthy country, and only so many people can afford Teslas at those prices. As for demand, overall demand, not just China, some people think that is going to drop too. What I think they're trying to say is that the aggregate demand for vehicles will drop, which would make it particularly difficult for any auto company to grow by selling additional hundreds of thousands of units each year. So let's take this from a few angles. In a recession, there are less buyers out there, with less money to spend on vehicles. If we take the definition of inflation being too much money chasing too few goods, then would that imply we're seeing deflation if we have less money chasing fewer goods? Therefore, if Tesla had to lower their prices to meet this new lower level of demand, it might also mean that their suppliers are lowering prices too. It would mean that the demand for commodities also drops, resulting in lower priced materials. Energy prices would inevitably come down too. Around the peak of the global financial crisis, oil was at an all-time high of $190 in June 2008, but it crashed to $58 in January 2009, about 6 months later, and nearly quarter the price, thus reducing the cost of just about everything. If things get as bad as we're saying, then this would likely be the rest of the scenario. Tesla's cost of goods will reduce. So if Tesla had to meet demand by lowering prices, their margins may still remain, perhaps not as high as before, but still enough to make a decent profit. Continuing on with the scenario where Tesla lowers their prices, it's not just about how low they go, it's about how low they are relative to the competition, of which I mean all cars, not just electric. Currently, Tesla might be a comparable price point to a BMW, whereas a slight drop in price might make them more of a competitor to something more mainstream like Volkswagen, and I'm talking about their ICE vehicles still. This would mean that Tesla will still have enough demand to sell their vehicles. And look at it the other way, if you were Volkswagen, you're feeling the economy too, and the loss in demand. Then suddenly Teslas become cheaper. Think how much pressure that puts on the likes of Volkswagen or Ford and GM. These companies don't have the luxury of a big margin buffer. On top of that, as their sales are dwindling, their OPEX per vehicle is also rising, as they don't have the operating leverage that Tesla does. And if you think it's hard for legacy, well, what about an EV startup that loses a fortune every quarter with only enough money to last perhaps another 2 years at these rates? How are they going to fare in such times? What solution do they have? Will they have to raise prices to increase profits to make up for the lack of demand? Or will they have to lower prices and get through their burn rate that much faster, making bigger losses? The proverb, "I don't have to outrun the bear, I just have to outrun you," feels incredibly apt here when Tesla is against the competition in the recession. And remember why Tesla felt like such a sure thing to us. Partly because they have this amazing pricing power with the ability to drop prices if they need. In fact, these prices are still higher than they used to be even 6 months ago. Even in China, Tesla used to sell their Model Y for less than they do now. I think people are forgetting this element to Tesla, and there are authoritative people in the community giving numbers that don't match this too, but they're having a lot of impact on what people think. People are saying that Tesla's margins will drop to an absurd 10% in China. But let's just do some easy math and talk about this. Now, I think most of us thought that Tesla were producing around 30% margins in Shanghai. We were on that level overall in Q1, and that was before the US price rises had even kicked in, or even the Shanghai price rises. Then we had this line upgrade, and if you can produce 30% more vehicles from the same factory, then the costs of goods sold reduce per vehicle, implying margins should have increased slightly higher again through these upgrades. Now, the previous price of Model Y was 316,000 yuan. At 30% margin, that would mean the cost of goods sold per Model Y is 221,000 yuan. The new price is now 311,000 yuan. That's how much Tesla get as they now qualify for the subsidy. The price to the consumer is slightly lower. Now, if we keep the same cost of goods sold per Model Y, Tesla's margin drops from 30% to 28.9%. Incidentally, at today's exchange rate, that's a cost of goods sold per vehicle of $31,000 per Model Y. This cost would have been much higher too before the dollar got strong, so I don't think this is an unreasonable estimate. But even if I drop the margin all the way down to 25% previously and do the same, then we're still down to 23.8% margin. But we would think that if that's what's happening, then other costs are coming down elsewhere too. The world governments are trying to deflate the world, so it should proliferate through to everything, including Tesla's costs of goods sold. But this is just for China, as in domestic sales for China. It doesn't account for the rest of the world. China is the global hub, and the only factory that makes these very low-cost Teslas. Remember, low-cost, standard-range LFP cells, not high-end luxury SUVs. And they still only make 1 million from this factory. Toyota make 10 million vehicles a year, and I'm pretty sure lately, when I drive around, I see a lot more new Teslas than I do Toyota, but maybe that's just where I live. Either way, it's not too insane a number if you have to sell them to the world. And I don't think Tesla have barely even started in anything like South America yet. The world is huge. They have a small presence in Japan too, given it's the third largest auto market of any other nation. So even if domestic demand in China has dropped, Tesla just need to work out the logistics of exporting more cars. And all these demand issues could be flipped upside down when we look at the US. Teslas are about to get a $7,500 discount in the US. Even despite that, Tesla is still selling cars in the US this Q4. Although I would guess there's a lot of pent-up demand there for people waiting for this discount to kick in. What people are concerned about happening in China, the opposite will happen in the US. Except the US is by far a bigger market for Tesla than China, and vastly more profitable due to much higher ASPs. Berlin should be okay. They'll cut a lot of costs when the new factory is ramped up, especially when they get the 4680 sales going. I imagine they will eventually just do long range there and use the Chinese exports for the standard range, so not really competing. And I'm sure Europe is starved for a 4680 Model Y. But even if they had to reduce prices to meet demand in Europe, then there is still a massive profit margin as a buffer for that. In the recession, if the Fed have broken the economy well enough, for lack of a better word, then that will mean they actually need to stimulate it again, and we would expect interest rates to drop. In fact, the US government can't afford to roll over their treasury bills at these rates anyway, so inevitably the rates will drop, which means the US dollar will eventually weaken again. This will lower the cost of goods sold further, whilst increase the actual profits from overseas. I keep saying though, China is the past, but it's still carrying Tesla considerably right now. But hopefully it won't take that long until it's not a major part of Tesla's market. In fact, not only market, but also production. Currently, China accounts for about 2/3 of Tesla's production, but we have these 4680 factories that we might expect to be at 150 gigawatt hours a year run rate, perhaps in mid-2024, if they hit capacity, on top of Tesla's supply from Panasonic and LG, i.e. non-China supply batteries. Tesla would have around 200 gigawatt hours there, compared to currently at a run rate of around 60 gigawatt hours a year in Shanghai, and that's from October, even after this latest line upgrade. In other words, Tesla's China production will go from about 2/3 to about 1/4, and China will no longer be such a big deal for Tesla. Anyway, I don't think you'll ever find a video where I said, come and invest in Tesla. It's easy to get rich and quick, with nothing to worry about. In fact, as early as last year, I made videos during the celebratory times, warning people to make sure that whilst we're up so much, to make sure you have some sort of insurance policy to carry you through if and when the market crashes, so you don't have to end up selling any stock or losing your house. This is just a time when you need to work harder on your investing skills. If you believe in the company and investment, then you might think that this is the time to be investing whilst the stock is down, despite the sound of impending doom and gloom. To be clear, this is not me suggesting you should. Always use your own judgment for your own circumstances. But if you want to see this through and believe in the company, then these are the tough times, and they may get tougher. If history does repeat, though, we should come out better on the other side. For example, Microsoft is up over 15 times today what it was at the bottom of the global financial crisis. But it had dropped over half from its high during that time. It's about surviving the times when the tide comes out to make sure you're still there when it comes back in. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.